Welcome to the Battlefield Trading YouTube channel. In today's video, we're going to dive deeper into the world of technical analysis by exploring price patterns. Together, we'll break down the key details behind these patterns and learn how to apply them in real trading situations. If you're ready, let's get started right after the intro.
Warning.
These days, there are plenty of chart patterns that traders use. But in this video, we'll focus on the ones we believe not only appear most frequently, but also deliver some of the highest success rates in trading. First, we have the double top and double bottom patterns. Second, the triple top and triple bottom patterns. Third, continuation patterns. Fourth, reversal patterns. Fifth, the head and shoulders pattern and the inverse head and shoulders pattern. And sixth, triangle patterns, channel patterns, and wedge patterns. Each trading pattern has its own strengths and specific applications depending on market conditions. By clearly understanding and flexibly applying these patterns, traders can better spot opportunities while managing risks effectively. Let's start with the double top and double bottom patterns. These often appear during market reversal phases, and traders rely on them to pinpoint entry and exit points. First, with the double top pattern, we typically see an uptrend. Then the price forms two peaks at roughly the same level. These peaks create a resistance level, while the low point between them is known as the neckline. So what does the double top tell us from a price action perspective? It shows that the price failed to create a new higher high, forming a second peak at the same level. This signals weakening bullish momentum, meaning buyers are no longer fully in control of the market. With the double bottom pattern, we usually see a downtrend first. Then the price forms two lows at roughly the same level. These lows create a support level, while the high point between them forms the neckline. So what does the double bottom tell you from a price action perspective? It means the price failed to create a new lower low, and instead formed a second bottom at the same level. This signals that bearish momentum is weakening, meaning sellers are no longer fully in control of the market. Understanding the price behavior behind these two patterns leads us to the next question. How do we actually use double top and double bottom patterns in our overall trading strategy? There are three common methods to trade these patterns. 1. Use the double top or double bottom pattern and enter a trade after the price breaks through the neckline. 2. Combine the double top or double bottom with key support or resistance zones. 3. Enter after a neckline breakout followed by a pullback. Let's start with the first method, entering a trade when the price breaks the neckline. First, you have a double top pattern with the neckline here. Once the price breaks below the neckline and forms a lower low, this confirms a trend reversal from bullish to bearish, and you set up a short position. Now, moving to the double bottom scenario. The price forms a neckline here between the two lows. When the price breaks above the neckline and makes a higher high, this confirms a trend reversal from bearish to bullish, and you set up a long position. Next is the second method, using a double top or double bottom pattern that forms at a strong support or resistance zone. Let's look at a stock chart example to see how this works. First, we have a strong support zone here. When the price approaches this support, it forms a double bottom pattern. Again, to confirm a trend reversal, the price needs to break through the neckline and create a higher high. Once the shift from a downtrend to an uptrend is confirmed, we look to enter a long position on lower timeframes like the 1-hour chart. There's also another way to confirm a trend change. You can draw a trend line like this, connecting the swing highs, and wait for the price to break through this trend line before looking for long trade setups. Now let's move to another example. First, we identify an important resistance level where the price has previously reversed. Then the price comes back to this resistance zone and forms a double top pattern. To confirm this reversal, the price needs to break below the neckline here and create a lower low. Right after receiving confirmation of a trend reversal from bullish to bearish, you can enter short positions on lower time frames, such as the 1-hour chart. In this example, Many traders who follow support and resistance strategies might choose to open trades at these points when the price reaches a strong resistance zone. Meanwhile, pattern traders would hold off and wait until a double top pattern fully forms and the price breaks through the neckline here. Both of these entry methods are valid. Different trading styles naturally lead to different ways of approaching the market. What matters most is sticking to your trading plan and having solid risk management in place. So, what's the advantage of using a double top or double bottom pattern at key support and resistance levels? This method takes a more cautious, high-quality approach to market entries. You're not just trading any random pattern. You're trading a pattern that forms precisely at a significant support or resistance level. This adds extra weight to your trade setup and improves your chances of success. Next, let's move on to the third method. Instead of opening a position right at the neckline breakout, we wait for a pullback before entering the trade. Looking at a stock chart example, we can see a double bottom pattern with the price already breaking through the neckline. But instead of entering a long position at the breakout point, we wait for the price to pull back to retest the new support level before entering. This approach increases your probability of success, since the price is now supported by both the neckline and the previous support level. Now let's move on to the next pattern, the triple top and triple bottom patterns. First, with the triple top pattern, the market is in an uptrend before forming 3 consecutive highs at roughly the same level. The swing lows between these highs create a support level known as the neckline. Once the price breaks below the neckline, we enter short positions because the trend reversal is confirmed. In the case of the triple bottom, it's the opposite. The market is in a downtrend before forming 3 consecutive lows at about the same level. The swing highs here create a resistance level called the neckline. Just like the triple top, when the price breaks above the neckline, we enter long positions because the bullish reversal is confirmed. In practice, trading the triple top and triple bottom patterns works very similarly to how we trade the double top and double bottom patterns. Let's continue with the next pattern, trend continuation patterns. In an uptrend continuation pattern, the price moves in a series of upward swings and pullbacks. The upward swings form higher highs, while the pullbacks form higher lows. From a price action perspective, this signals a continuation of bullish momentum, as buyers remain in control by consistently pushing the price to create higher highs and higher lows. On the other hand, in a downtrend continuation pattern, the price moves in a series of downward swings and rebounds. The downswings form lower lows, and the rebounds form lower highs. From a price action point of view, this indicates a continuation of bearish momentum, as sellers stay in control by driving the price to create lower lows and lower highs. Now, let's move on to the next pattern, trend reversal patterns. In an uptrend, there are 2 ways a reversal pattern can form. First, the market is in an uptrend, creating higher highs and higher lows. Once the price forms a new low that's lower than the previous low, it signals a possible trend reversal in an uptrend. Second, the market continues its uptrend with higher highs and higher lows. But when the price forms a lower high followed by a lower low, that also signals a potential trend reversal within an uptrend. From a price action perspective, an uptrend reversal pattern indicates a loss of bullish momentum, as buyers fail to push the price to new highs. In a downtrend, there are also 2 ways a reversal pattern can develop. First, the market is in a downtrend, consistently making lower lows and lower highs. When a rebound creates a new high that's higher than the previous high, it signals a potential trend reversal in a downtrend. Second, the market remains in a downtrend with lower highs and lower lows. A reversal pattern forms when the price makes a higher low, followed by a higher high. From a price action point of view, a downtrend reversal pattern shows that sellers are losing momentum as they fail to push the price to new lows. Now, let's move on to the next pattern, the head and shoulders pattern, and the inverse head and shoulders pattern. The head and shoulders pattern starts with an uptrend, where the price forms a peak called the left shoulder, then a higher peak called the head, followed by a lower peak called the right shoulder. The 2 swing lows here form a support level known as the neckline. From a price action perspective, the head and shoulders pattern signals weakening bullish momentum and the start of a possible trend change when a lower high appears after a previous higher high. There's also a higher quality variation, a head and shoulders pattern with a sloping neckline. It's similar to the standard pattern, but here the price forms a lower swing low after each peak. From a price action standpoint, this is considered a stronger reversal pattern because the price not only makes a lower high, but also creates a lower low, confirming that the trend reversal is fully taking shape, not just giving a warning signal. On the other side, the inverse head and shoulders pattern starts with a downtrend. The price forms an initial low called the left shoulder, then drops further to create a lower low called the head. Finally, it forms a third low that's higher than the head and roughly equal to the first shoulder. The swing highs create a resistance level known as the neckline. From a price action perspective, the inverse head and shoulders pattern shows weakening bearish momentum as the price fails to make new lower lows and instead forms a higher low. This is a strong signal that a market trend reversal may be starting. Just like with the standard head and shoulders pattern, there's also a higher quality variation of the inverse head and shoulders pattern when the price forms a sloping neckline. From a price action perspective, this is considered a stronger reversal pattern because the price not only creates a higher low, but also forms a higher high. This confirms that the trend change has been completed, rather than just hinting at a possible reversal. Now that you understand how the head and shoulders and inverse head and shoulders patterns work, you're probably wondering how to actually apply them to a real trading strategy. But before we get into that, once again, if you're enjoying this video, hit the like button and subscribe to our channel to support us. And don't forget to leave a comment if you have any questions, opinions, or suggestions for future topics you'd like us to cover. All right. Let's move on to how to use the head and shoulders and inverse head and shoulders patterns in stock trading. There are three main methods to trade these patterns. First, trade when the price breaks through the neckline. Second, trade on the pullback or rebound after the price has already broken the neckline. Third, trade at the right shoulder of the pattern using multi-time frame analysis for confirmation. Let's start with the first method, which is trading when the price breaks through the neckline. First, the price is in an uptrend and forms a head and shoulders pattern with the neckline here. Once the price breaks below the neckline and creates a lower low, you would set up a short position at this point. In the opposite scenario, the price is in a downtrend and forms an inverse head and shoulders pattern with the neckline here. Similarly, we wait for the price to break above the neckline, then set up a long position as the trend reversal has been confirmed. We move on to the second method, which involves a head and shoulders pattern. After the price breaks the neckline, instead of entering a trade immediately, as in the first method, we wait for a pullback toward the neckline before executing the trade. The same applies to the inverse head and shoulders pattern. After the price breaks above the neckline, we wait for a retracement before entering the trade. Now, let's move on to the third method, trading at the right shoulder of the head and shoulders pattern using multi-time frame analysis. First, on the weekly time frame, the price is in an uptrend. We identify the left shoulder, then the head of a potential head and shoulders pattern. Now, as the price moves up to form the right shoulder, it approaches a key resistance level. At this point, we observe the price behavior on the daily time frame to look for trade opportunities. On the daily chart, we see the price forming a double top pattern as it reaches that resistance area from the weekly time frame. Then, we can set up a short position on the 1 hour time frame as soon as the price breaks through the neckline of the double top pattern on the daily chart. Now, let's move on to the next section. Triangle patterns, channel patterns, and wedge patterns. We group these three types together because they have similar variations and are used in comparable ways. Let's start with triangle patterns. There are three main types of triangle patterns: the ascending triangle, the descending triangle, and the symmetrical triangle. First, the ascending triangle is characterized by a horizontal resistance line formed by equal highs and an upward sloping trend line formed by higher lows. The ascending triangle pattern can form in both bullish and bearish markets. In a bullish market, the price rallies strongly and then forms an ascending triangle pattern as it consolidates. In a bearish market, after a sharp drop, the price may also form an ascending triangle as it begins to stabilize and consolidate. Next is the descending triangle pattern. This pattern is formed when the price creates a horizontal support line with equal lows and a descending trend line above with lower highs. The descending triangle can also appear in both bullish and bearish markets. In a bullish market, after a strong upward move, the price may form a descending triangle as it consolidates. In a bearish market, after a sharp drop, the price can also form a descending triangle pattern. Let's continue with the symmetrical triangle. This pattern is formed when the price creates a descending trend line above with lower highs and an ascending trend line below with higher lows. In a bullish market, the price rallies strongly before forming a symmetrical triangle. In a bearish market, after a sharp decline, the price may also consolidate into a symmetrical triangle. Before we move on, here's something important you need to remember when using price patterns. When drawing chart patterns, treat them as relative guidelines, not perfect shapes. The stock market is never perfect, and neither are its patterns. If you wait for textbook perfect patterns to appear, you'll miss out on 90% of good trading opportunities. To succeed as a trader, you need to develop flexible thinking in an imperfect and constantly noisy market. Next, we have the channel patterns. There are 3 variations of this pattern: the ascending channel, the descending channel, and the horizontal channel. Let's start with the first one, the ascending channel. This pattern is formed by an upper trend line with higher highs and a lower trend line with higher lows. These 2 trend lines run parallel and slope upward. The ascending channel can appear in both bullish and bearish markets. In a bullish market, after a strong rally, the price may form an ascending channel as it consolidates. In a bearish market, after a sharp decline, the price can also bounce and form an ascending channel. Next is the descending channel. Opposite to the ascending channel, the descending channel is formed by a downward sloping upper trend line with lower highs and a lower trend line with lower lows. These 2 trend lines run parallel and slope downward. This pattern can also appear in both bullish and bearish markets. In a bullish market, after a sharp upward move, the price might pull back and form a descending channel. In a bearish market, after a strong decline, the price may continue consolidating in a descending channel. And finally, we have the horizontal channel. This pattern is formed by a horizontal resistance line above, created by equal highs, and a horizontal support line below, created by equal lows. It can appear in both bullish and bearish markets as well. In a bullish market, after a strong rally, the price may enter a horizontal channel. In a bearish market, after a sharp drop, the price can also form a horizontal channel during consolidation. Now let's continue with the next pattern, the wedge pattern. There are 2 variations, the rising wedge and the falling wedge. Let's start with the rising wedge. This pattern is formed by an upward sloping upper trend line with higher highs and an upward sloping lower trend line with higher lows. The key point here is that these 2 trend lines are converging while both moving upward. The rising wedge can appear in both bullish and bearish markets. In a bullish market, after a strong rally, the price may form a rising wedge. In a bearish market, after a sharp decline, the price can also consolidate into a rising wedge as it attempts a recovery. Next is the falling wedge. This pattern is formed by a downward sloping upper trend line with lower highs and a downward sloping lower trend line with lower lows. The important detail here is that these 2 trend lines are also converging, but both moving downward. The falling wedge can also appear in both bullish and bearish markets. In a bullish market, after a strong rally, the price might pull back and form a falling wedge. In a bearish market, after a sharp decline, the price can continue consolidating into a falling wedge before a potential breakout. So, we've just covered triangle patterns, channel patterns, and wedge patterns. And before we dive into how to apply these 3 patterns in real trading situations, if you found this video helpful so far, make sure to hit the like button and subscribe to the channel to support us. And feel free to leave a comment if you have any questions, thoughts, or topic suggestions you'd like us to cover in future videos. Now, Let's move on to how to apply triangle, channel, and wedge patterns in real stock trading. Basically, when the price is moving within a major trend and one of these patterns appears, whether it's a triangle, a channel, or a wedge, you should wait for a strong breakout from the pattern and then trade in the direction of that breakout. You can use any entry technique you find effective or refer to a few of these common trading methods. Method 1. Trade when the price breaks the trend line of the pattern. Method 2. Trade on the pullback or correction after the price breaks the pattern's trend line. Method 3. Trade at key support or resistance levels combined with the pattern. Let's start with trading the breakout of the pattern's trend line. Here's the daily chart for SSI stock. We can clearly see that the price is forming a rising wedge pattern with the upper trend line connecting higher highs and the lower trend line connecting higher lows. Once the price breaks the trend line of this pattern, we'll place a trade in the direction of the breakout. With these two strong bullish candles, the price has broken through the upper trend line, so we would choose to enter a long position right here. After that, you can switch to a 1-hour time frame chart to find more optimal entry points for your buy trades and also manage risk by setting appropriate stop-loss orders in case this breakout turns out to be a false one. On this same chart, we can also apply the second method. Instead of entering a buy position immediately at the breakout point, we wait for a pullback after the price breaks the pattern's trend line and only then place a buy order. Now, let's move on to the third method, trading at strong support or resistance levels combined with a chart pattern. On the daily chart of DOC, we can clearly identify a strong support zone here, as the price has reacted to this area multiple times in the past. The price forms a triangle pattern right above this support level. So when the price breaks out above the upper trend line of the pattern, we immediately enter a long position. And with that, we've completed a journey through some of the most important price patterns and how to apply them in real-world trading situations. Mastering and smartly applying these trading patterns will help traders optimize profits and minimize risks. However, always remember, no pattern is perfect. Every trade setup should be paired with proper risk management strategies to achieve the best possible results. We hope the insights we've shared in this video give you a clearer understanding of the stock market and more confidence in making trading decisions. Make sure to follow our channel for more practical trading knowledge in the future. Thank you for joining us on this journey, and we'll see you in the next video.